Hello everyone, myself Deepak Gupta logging on this platform of College Dekho Learn, and we will continue today our journey on dividend policy decision. So as discussed in our earlier session on the Walters model, which underlined that the dividend decision will impact the value of the firm, that is the market price of the share denoted by P, but that affection or that impact between or that relationship between the dividend policy and the value of the firm in the Walter model were dependent whether the rate of return of the company was more or less or equal to the return which was available to the equity shareholders on their investment, which was denoted by the symbol KE. So whether the dividend, that is the DP ratio, will have a positive impact or inversely impact or no relationship with the value of the firm that depended upon this comparative figures of R and KE. But if I move forward with the Gordon's model today, then Gordon's model clearly underlines and supports the view of the Walter model in the way that it also says that your dividend decision will always impact the value of the firm, but they have taken a very straightforward approach. And that straightforward approach is based on a basic assumption or a synonym that says that a bird in hand is always better than the two in the bush. मतलब कि अगर आपको दो दो मुर्गे मिल रहे हैं लेकिन वो मुर्गे आपको जगह पकड़ने पड़ेंगे झाड़ी में से, और इसकी जगह अगर आपको एक मुर्गा हाथ में कोई पकड़ा के दे रहा है तो वो एक बर्ड है, जो एक जो आपका असेट है जो आपके हाथ में है, जो आपको बेनिफिट देगा फ्यूचर में, वो कहीं ना कहीं ज़्यादा बेनिफिट है उन दो के मुकाबले, बिकॉज दिस बर्ड इन हैंड इज लेस रिस्की, whereas there is a risk that in when you want to get two you may end getting nothing. So on the same lines, he, Mr. Gordon, underlined the impact that a investor will always prefer a investor will always prefer a current dividend. That is, the dividend which is received now will always be better than the dividend that will be received in the future. Also, as and how the dividend increases, the growth of the dividend must be there in relationship to the growth of the company, and this growth of the dividend will also increase the price of the equity share. So, as per the Gordon's model, the price looks to be directly proportional to the dividend per share, and the price looks directly proportional to the growth rate of the dividend. How and what is this growth rate, that I am just going to discuss. But this market price, as per Gordon's model, is going to be directly proportional to the dividend per share and the growth in the dividend per share, and making a clear impact that when we compare two companies, then the one with the higher dividend or higher growth of dividend should be having higher price as compared to the other. And for this theory, he underlined certain basic assumptions and also created his personalized formula to justify his valuation of the price. So, if we move into those assumptions, so first we have to understand that what this growth rate implies. Growth rate denoted by the word G. So, a company, for example, if we take dividends for the past 5 years, so I should take, so if we take dividend for the past 5 years, that is 2017, 2018, 2019, 2020 and 2021. So one company X Limited could have paid a dividend of rupees 10 per share in each of the 5 years. Another company Y Limited could have a policy where the dividend is 10, 10, 10, and after some time it may give an enhanced dividend, say rupees 10 plus 5, that is 15. So what is happening here, that this company X Limited is following a policy where the dividend each year is same irrespective of the EPS. So if I also give the data of earning per share and let's presume it was 20, 24, 18, 16 and 22. So whether the EPS increases or decreases, the company may distribute similar dividend. So we say that the company is following a constant dividend regime. One of the companies can follow the concept that they will give a fixed dividend of rupees 10, and sometimes they can increase it and they can show certain lump sum increase in the dividend in a particular year, and then they can come back to their original dividend policy. So this policy of dividend distribution is known as that you are getting a constant dividend of rupees 10 plus sometimes that extra for various reasons, various logics as explained by the company. Another company was Z Limited may follow that we will always distribute 50% of their retained earnings. So in that case, in the first year they will give 10, 50% of 20, then they will give 12, then they will give 9, then they will give 8, then they will give 11. So this policy, though looks constant in the terms of DP ratio, in the terms of DP ratio, but still the investor is quite uncertain because in spite of the constant policy followed by the company, what the amount is going to be received by the shareholder equity holder is not fixed, and it creates a sense of insecurity in the hands of the investor, and that adversely affects the price of the equity share because of the inherent risk involved. So, in addition to these three approaches, normally companies are presumed to grow, so they estimate their growth rate, and on the lines of that growth rate in their sales, they devise a way where they always give a constant dividend, but this constant dividend is not fixed like in the first case rupees 10, that there is always a base dividend starting from a particular year, that is the year from which they started this policy, and the dividend will grow at a fixed growth rate. Now, these growth rates can be multiple, that after a few years they can change it, but at the moment we presume that they have a fixed growth rate. For example, if the growth rate of the company is say 4%, then in the first year if they're starting with 10, then in the next year they will be 10.4. It means अगर 2017 के डिविडेंड रुपीज 10 को हम बेस ईयर लेके चल रहे हैं, यानी कि करंट डिविडेंड लेके चल रहे हैं, then the D1 of 2018, that is D1, this D1 will be equal to D0 plus G, and that comes out to be 10.40. Similarly, when we go to the year 19, that is the D2, then the D2 will be D1 plus G, that is 10.4 plus 4%, and that comes out to be 10.82. On the same lines, the D3 will be equal to D plus D2 plus G, and it will go on so that. So here the G denotes a fixed growth rate. It denotes a fixed growth rate of dividend each year on the earlier dividend declared. On the earlier dividend declared. So why this was discussed, that when the Gordons created their concept, then they believed that there will always be a growth in the business, and the growth in business will be compensated by the growth in dividend, and hence the company will pass their increase in the profitability to the shareholders at a fixed predetermined growth rate. Now they also assumed that this growth rate will be equal to the multiplication of B and R, and here the B denotes the retention ratio, the B denotes the retention ratio, and R is the rate of return for the company as discussed in the Walters model. So if, for example, the rate of return for a company is 12% and the DP ratio is 50%, it means the retention ratio is also 50%. So here the G will be equal to 50% retention ratio multiplied by the 12% rate of return, and hence this G will come out to be 6%. And one of the most important assumption was that this G is always presumed to be less than the cost of the equity. That is what K denotes here. It is the rate of return for the shareholder, which is actually the cost of equity for the company. So whatever is the cost of the equity, that is how much dividends is being paid by the company each year. So that cost expressed in terms of the percentage is always more than the growth rate. That is, each year the dividend is not growing at a faster pace than how much was paid as the cost of the equity, that is the dividend. And with these three assumptions, Mr. Gordon advised that the price is directly proportional to the dividend. It means as the dividend increases, that is, as the dividend increases, so the price will increase. तो जैसे जैसे डिविडेंड बढ़ेगा, price of the share increase होगा, and price is also proportional to the growth rate of the dividend. That is, as the dividend grows, so the price will increase. तो उन्होंने शेयर की वैल्यू को, वेल्थ मैनेजमेंट को डिविडेंड पॉलिसी से रिलेट कर दिया इन अ पॉजिटिव वे विद अ सिंपल सिंप्लीफाइड एंड स्ट्रेट अप्रोच. एंड टू सपोर्ट their theory, he advised a formula for the calculation of the price of the equity, where the price of the equity is equal to E1 minus B divided by KE minus BR. And if we analyze this formula, this E denotes the earning per share, this B denotes the retention ratio. And as discussed in our earlier session on Walters model, 1 minus B shall be equal to the dividend payout ratio. So effectively, the DP ratio is equal to dividend per share upon earning per share. So this E multiplied by 1 minus B becomes equal to EPS into DP ratio, and that itself becomes the DPS. So effectively, E1 minus B denotes the DPS. So this formula can be that if we take that the current market price, then it is actually the D1, that is the dividend to be declared after 1 year in anticipation of what you are going to get. So if we see here that the price is directly proportional to the dividend, which justifies this claim. Second important thing was that he has assumed that G was equal to BR. So if we change it figure here, then this KE minus G. So Gordon model can also be expressed in this format, where you will find that this denominator can be negative if G is more than KE. So his earlier assumption came into play, which said G is always less than KE, and therefore here the denominator will never be negative. and hence there will always be a positive market price calculated. So as soon as the company is declaring dividend, because until the dividend is there no calculation or market price can be zero. So as far as the dividend is being distributed, the company is always going to have a positive market price. So we can always adapt this Gordon model formula to this format. Now, if we arrange an example to justify his theory, then we can always see that if the sales, I'm creating a bigger example, if the sales of a company is say 10 lakhs and the profit volume ratio is 40%, the rate of return for the company is say 10% as taken above, the growth rate is not provided, the retention ratio is 40%, that is the dividend payout ratio is 60%, and the cost of equity is, let's say, 12% per annum. The total fixed cost of the company is say 1 lakh. The taxes are to be ignored and the number of equity shares available with the company is say 1 lakh. So what is happening here? That is the sales is 10 lakhs, out of which we calculate the variable cost, which is for 60% because the PV ratio is 40%. So this will be variable cost. The 4 lakhs will come out to be our contribution. If we deduct the fixed cost of 1 lakh, then we can have an earning before interest and tax of 3 lakh. There is no information on the interest, so if we presume the interest is 0, so the EBIT will be equal to EBT, that is 3 lakh. If no tax rate is given and we ignore it, then the earning after tax will be 3 lakhs. As there is no information on the preference capital, so we say preference dividend is 0. So this becomes a 3 lakh, that becomes the E, that is the earnings for the equity shareholder. So the EPS will be equal to E, that is the earnings for equity divided by the number of equity shares. So which is here 3 lakhs divided by the number of equity shares 1 lakh, that is rupees 3. So here if we calculate the price of the share, then it will be equal to E 1 minus B upon KE minus BR. So this E will be here 3. Retention ratio is 40%, so 0.40 divided by KE, which was 12%, that is 0.12, and we deduct B into R. Here the R was 10% and the retention ratio was 40%. So this P will be equal to 1.80 divided by 0.12 minus 0.04. So it will be equal to 1.80 upon 0.08. So we can say the price of the share will be equal to rupees 22.50. 22.50. So if we can see that on an earning of rupees 3, the estimated price of the share is approximately 22.5. So if I divide market price with the EPS, then it comes out to be 22.50 upon 3, and that comes out to be 7.5. So this 7.5 is known as a price earning ratio. So this company's expected price is having a low PE ratio of 7.5. So this concept can also be used for decisions regarding investment, regarding the valuation of the equity, where this company is presumed to be operating at a very low P ratio, which makes it an attractive investment opportunity. So why we have tried to relate it, that all these concepts of financial management are very important to clearly understand the concepts of investment management. So if you are following our sessions and specifically my sessions on our channel College Dekho Learn, then you will see that normally we have a session on financial management, and then it is also supplemented by another session on investment management. And effectively, investment management is the application of the financial management. If somebody is from DU, then they must know that this financial management is in semester 5 of the Delhi University third year, and the paper investment management, also known as the fundamentals of investment, is in the sixth semester, and they are actually in continuation. That a single concept has been taken basically in the form of financial management in fifth semester, and then its application in the sixth semester as the investment management, because all these basic fundamentals of financial management can be used as a tool to have a much informed and better decision on investment. So if you see here, then from a simple figure of sales, we are able to decide whether the investment is risky or not, because high P ratio makes an investment little unattractive because of the inherent risk involved. Because of the inherent risk involved. Now, in this question, earlier the detention was 40%, it means the dividend distributed was 60%. Now, if I again calculate making B as a 20%, that is the dividend payout ratio is now 80%. That is, if earning was rupees 3, the dividend now will be 3 into 80%, that is 2.40. So keeping the other particulars same, if I again calculate the P, so it will be E 1 minus B divided by the KE, and the KE was 0.12 minus BR. R was 10% and B was 20%. So what will happen here, that it will be 2.40 divided by 0.12 minus 0.02. So you will see 2.40 upon 0.10. So the market price will now be 24. So if you see here, when the dividend was rupees 1.80, the price was 22.5. If the dividend was 2.40, then the price has increased to 24. So as discussed, as the dividend increases, the price also increases. Price also increases. So we can always now relate that in its parameters of assumptions and the formulas, Gordon has justifiably anticipated the impact of the dividend policy on the price of the equity, which can be used also for the concepts of the valuation of the equity and calculation of price earning ratio for take a better fundamental analyzed view on the choice of the security to be made. On this note, myself Deepak Gupta logging off from this platform of College Dekho Learn, and I hope to see you again on our next session. Thank you very much. Goodbye.